wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we endeavor to keep you informed of the latest developments in the financial markets with a view to helping you make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 170, and in this episode we're reviewing the performance of the financial markets during the 30th week of 2025, and that is from Monday the 21st to Friday the 25th of July. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off with a quick update on the ongoing tariff war, as the European stock market closed above their session lows on Friday. This was after President Trump said there was a 50-50 chance for a trade deal with the European Union. Earlier in the week, President Trump announced a trade agreement with Japan, which included reciprocal tariffs of 15%. Financial markets are now focusing their attention to trade negotiations with the European Union, as President Trump was expected to meet with the European Commission President this past weekend. Over to the European Union, where on Thursday the European Central Bank decided to keep its benchmark policy rate on hold amid major economic uncertainty as the European Union scrambles to negotiate a trade deal with the United States before the end of July. The European Central Bank has implemented 4 rate cuts of 25 basis points each so far this year, taking its key policy rate from 3% in January down to 2% in June, and maintained the same rate in July. According to the European Central Bank, the global environment remains exceptionally uncertain, especially because of the ongoing trade dispute with the United States. And with inflation in the Eurozone area now in line with the central bank's target rate of 2%, the market was widely expecting the central bank to keep its policy rate on hold this month, mainly due to the uncertainty created by the ongoing tariff war. For your information, the United States is the largest trade and investment partner for the European Union, as the 27-member bloc exported goods worth about $590 billion to the United States in 2024. Over to the United States, where, according to a report by CNBC, Goldman Sachs and the Bank of New York Mellon are set to announce the launch of tokenized money market funds. This means that institutional investors with the Bank of New York Mellon, which is the world's largest custody bank, will soon be able to purchase tokenized money market funds whose ownership will be recorded on Goldman Sachs' blockchain platform. The tokenizing of the money market industry, which is valued at about $7 trillion, is the next leap forward for digital assets after President Trump recently signed into law the Genius Act, which is expected to boost the utility of stablecoins. However, unlike stablecoins, tokenized money market funds pay out a yield, making it an attractive holding solution for institutional investors to park their short-term cash reserves. For your information, tokenization simply refers to the process of creating a digital representation of the real thing. In this particular case, tokenization refers to the process of turning financial assets into digital assets by creating a ledger on a blockchain that represents that financial asset. On Wall Street this past week, the S&P 500 rose on Friday, closing out a winning week after receiving a boost from solid earnings results and the announcement of a trade deal between the US and Japan. Earlier this past week, President Trump announced a trade agreement with Japan as markets shifted their focus to trade negotiations between the United States and the European Union. All the three major averages closed the week in positive territory, with the S&P 500 gaining by about 1.5% this past week and posted its 14th record close of the year at 6,388, whilst the tech-heavy Nasdaq Composite rose by 1% to record its 15th record close in 2025, as it closed at 21,108. Meanwhile, the Dow Jones Industrial Average advanced by about 1.3% during the week to settle at 44,901. In the U.S. government bond market, the yield on the benchmark 10-year Treasury bond moved lower on Friday as investors weighed the latest developments on trade tariffs as well as economic data released during the week. After announcing a trade agreement with Japan, President Trump is now turning his attention to trade negotiations with the European Union and was expected to meet the European Commission president this past weekend. Higher tariffs on U.S. trading partners will most likely translate into higher prices for U.S. consumers, who are a major contributor to U.S. economic growth. A slowdown in U.S. consumption is already being factored into the outlook, with analysts projecting that U.S. economic growth will slow down to around 1.6% by the end of this year. In addition to that, the Federal Reserve is scheduled to meet this coming week, and policymakers are widely expected to keep the central bank's benchmark borrowing rate at its current range of between 4.25% to 4.5%. In response to the foregoing, the yield on the benchmark 10-year Treasury bond fell by more than 2 basis points to close at 4.38%, whilst the yield on the 2-year Treasury note was down by less than 1 basis point to close the week at 3.91%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil eased off on Friday and settled at a 3-week low as traders projected reduced demand for fuel oil, mainly driven by higher tariffs and the subsequent increase in consumer prices as the United States continues to impose tariffs on its major trading partners. Earlier this past week, the United States announced a trade agreement with Japan and said it was looking forward to trade negotiations with the European Union this past weekend. In response, the price of the global benchmark Brent crude fell by about 1% this past week to settle at $68.44 per barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this was down by about 3% for the week before coming to a close at $65.16 per barrel. In the precious metals market, the price of gold slipped on Friday, weighed down by a stronger dollar and signs of progress in trade negotiations between the US and the EU, which dented the safe haven demand for bullion. As the yield on U.S. Treasuries rose, the U.S. dollar index rebounded from a more than 2-week low, which made gold more expensive for buyers using other currencies. Meanwhile, the trade deal with Japan and the prospect of another trade deal with the European Union has helped to reduce the level of risk sentiment in the markets, which normally drives up the demand for safe haven assets such as gold. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. In response, the price of spot gold fell by 0.9% to finally settle at $3,336 per ounce. In the cryptocurrency market, following 3 consecutive days of outflows, Bitcoin ETFs recorded an inflow of about $226 million on Thursday, as Ether ETFs continued their positive streak with 15 consecutive days of inflows. Bitcoin ETFs has seen about $58 million in outflows this past week, and this is compared to Ether ETFs, which saw weekly inflows totaling to about $1.39 billion. This divergence between Bitcoin and Ether ETFs suggests that Ether is better positioned and will continue to outperform Bitcoin in the near term. This is mainly due to institutional demand and the critical role that Ether plays in supporting on-chain infrastructure like tokenized assets and stablecoins. In response, the price of Bitcoin was broadly flat at around $118,000 per coin, whilst the price of Ether was up by 1.6% and was last seen hovering around $3,700 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week the Kenyan shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.26 compared to a rate of 129.24 recorded the previous week. Meanwhile, the sterling pound was priced at 175.55 and the euro was valued at 152.25. And on the regional front, one Kenya shilling was changing hands for 27.77 Ugandan shillings and 20.15 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.16. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by a massive $436 million for a grand total of $10.74 billion, which is equivalent to 4.7 months of import cover. This level of reserves is still in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.62% compared to a rate of 9.64% the previous week, but was still pretty much in line with the central bank rate at 9.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 8.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 24th of July, and the central bank received bids totaling to 40 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 166%. The central bank ended up accepting only about 62% of the bids as it took in 25.5 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1 basis point to average out at 8.11%, whilst the 182-day rate also slid by 1 basis point to settle at 8.41%, and the 364-day rate ticked lower by less than 1 basis point for a weighted average rate of 9.71%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the Treasury bond auction for the month of August, and the central bank is looking to raise a total of 90 billion shillings through the sale of 2 reopened fixed coupon infrastructure bonds, whose terms and conditions are as follows. The first bond is a 15-year bond that was initially issued in 2018 and now has 7.5 years left to maturity and matures in January 2033. This bond has a fixed coupon rate at 12.50%. The second bond is a 19-year bond that was initially issued in 2022 and now has 15.6 years left to maturity. This bond matures in January 2041, and the bond has a fixed coupon rate at 12.96%. Please note that these bonds are now open for sale until Wednesday, the 13th of August, when the auction will be held. And as is the norm with infrastructure bonds, the interest earned from these bonds is exempt from withholding tax. Up next is our topical issue. This week, we're looking at Kenya's difficulty in accessing external sources of financing. The global rating agency Moody's has indicated that Kenya will face difficulties in sourcing external financing without the support of programs from the World Bank and the International Monetary Fund. Without the support of the World Bank and the IMF, Moody's has said that Kenya will have no alternative but to utilize its official foreign currency reserves in order to service its external debt obligations. And with a domestic borrowing target of 635 billion shillings for the current fiscal year, Moody's has warned that excessive government borrowing from the domestic market is likely to crowd out the private sector and lead to slower economic growth, as banks also prefer the safer lending to the government. Moody's reckons that Kenya will find it extremely difficult to access external financing as potential investors initially consider the approval of concessional funding programs from the World Bank and the IMF as a sign of confidence in the country's credit worthiness. Moody's warning comes at a time when Kenya has been unable to unlock funding of $750 million from the World Bank due to unmet terms and conditions. Kenya is currently without a program from the International Monetary Fund following the termination of a multi-year funding arrangement in March 2025 as a result of missed targets, including revenue underperformance. Moody's is of the view that Kenya's fiscal sustainability is tied at the hip with the World Bank and the IMF, as financing from these organizations is crucial to the country's ability to meet its external debt obligations. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it ain't how hard you hit. It's about how hard you can get hit and still keep moving forward. That's how winning is done. Think about it. Thank you, and God bless.